Hi, everybody. This is Larry Green with Mercury Leadership again, doing a podcast today. And we're going to talk a little bit about finance and the difference between a controller and a CFO. A lot of the businesses, all the businesses that I work with, have someone in the finance department, depending on the size of the business. If they're smaller, then the owner is heavily involved, if not the primary person that's managing the finances, along with maybe a bookkeeping or an accounting department. The larger businesses often will have somebody at a little higher level of accounting, and depending on their level of experience, they'll have a title of either accounting manager, a controller, or a CFO. When I get into the middle-sized businesses from 10 to 50 million in revenue, if you will, I often find that those titles may be a little misapplied. They might have a title that's a little above their actual knowledge or experience base. So let's just talk a little bit about what the businesses need. In the small businesses, they oftentimes in the smaller businesses under $5 million, oftentimes they really are kind of managed by their bank balance. As long as we have money in the bank to operate another day, we're good. Or maybe it's a little bit further, or they just maybe amass some cash, and then that's the method and the resources that they have to run the business. As long as we got cash in the bank and maybe enough for 3 more payrolls or something along that line, then we're good to keep operating. Sometimes they don't have any more analysis or anybody really looking further out than some of those metrics. And as they get bigger, over the 10 million, 10 to 50 million, or 10 to 100 million, something like that, then they need a little bit more horsepower, if you will. So oftentimes, let's talk about a $25 million business roughly. Oftentimes, they'll have an accounting department made up of 2 or 3 people, and one of them is a manager. And that manager typically will be at an accounting manager level, or maybe a step above that at a controller level. But very few of them will have the CFO, Chief Financial Officer, in place. Sometimes they'll have fractional, to where they'll have somebody come in once a month and review what the accounting manager or the controller has been doing, and operate from that mind frame, if you will. And so what I find that's lacking is, even if you have that structure in place, oftentimes the owner, the CEO, president, whatever title they carry, but typically they are closely held businesses with one owner, maybe 2 partners, something like that, that own the business, and they'll run with this type of a structure. And oftentimes I will find that the accounting person, controller, will maybe even have more control, or most of the control, on the actual finances, accounts payable, accounts receivable, bank balances, that type of thing, than the owners do. And I often find that they'll leave that control without any oversight or any checks and balances in place for years on end. And that's the dangerous situation, because if you don't have any checks and balances, that leaves it open for fraud, mistakes, big mistakes, errors. They could also have a situation where if they have any type of a cyber attack, that person is in charge of the security of their finances as well, and that can be leave their finances actually at risk. I've actually had a few cases where clients have been hit by ransomware. Fortunately, none of them have lost any money. A couple of them have come within one keystroke of wiring money to a fake account when they thought it was a real account, but they dodged a bullet almost by coincidence. But those are the types of things that you can have be at risk if you as the owner don't have the right checks and balances in place. To dig a little bit deeper into that, one of the questions I'll ask clients early on, we talk about cybersecurity, of course. That's one of the very first things to see where they are. And the other one is, I'll ask, who has check signing authority? And it's common that there will be themselves, but then a bookkeeper or controller will have it. But I say, okay, what are your checks and balances? And they really don't have any. One old school method that one of my longtime CPA friends taught me is that if the controlling person, the accounting person, does the bank reconciliation, then the physical bank statement should only come to or be available to the owner. In other words, that's one level of checks and balance. In this day and age where almost everything is done online, then that would limit that controller person to have certain access to the bank statements, but not all access. So there's ways to divide the access, if you will, and the control so that it's not all concentrated with one person. I've got a longtime friend who was a CFO that even for a much larger company, in spite of all the checks and balances they had in place, a longtime employee found a way to write checks, even though they did almost no physical checks. They were able to write checks and deposit them in their own account and then change some name on the check in their accounting computer system. And it wasn't caught for many years. And in the end, this person, after almost, I believe, 30 years with the company and extremely well paid, they were able to embezzle over $4 million, one check at a time. And I've heard many stories about embezzlement in much less sophisticated situations as well. So not to say that anybody and everybody's going to be a criminal or take advantage, but it's a really bad idea to leave it open to that possibility. So that's just something to think about. If you're a business owner and you've gotten really comfortable with a longtime employee, even maybe a family member, you just might want to rethink that and look at ways to put some checks and balances in place. Again, doesn't mean there's necessarily going to be embezzlement, but there could be errors that you're not seeing. Another scenario recently, it just comes to mind, was they didn't have controls and they found out that certain invoice had never been paid. And it was really a sloppy situation where one of their larger clients called about an invoice, and then along the way they discovered that the company had never billed them for certain business. So I mean, really no checks and balances. I mean, it's really a dangerous game if you're not careful with that. But to get back to the point here, talking about a controller versus CFO, I find out that owners typically don't know the difference in mid-sized companies of those two, controller versus CFO. Or there was an old term, I don't think it's used as much anymore. It was comptroller. I'd actually have to look up, but I think it was similar to controller that was in place in an accounting manager. And again, oftentimes the controllers are overtitled. They really are only accounting managers. They don't have the education and the experience to be controllers. They really should be an accounting manager reporting up to a controller or a CFO, but that's often the case. And some people will be hired as CFOs when they're vastly underqualified, but the owners don't know it. They decide they need a CFO. So the simplest example or the simplest description that I use when I'm talking to leaders about these roles is a controller or accounting manager, anyone that's below a true CFO, chief financial officer, often deals transactionally. They deal with what's going on today and in the past, reporting, and just managing day-to-day cash, bank balances, transaction, managing the staff, and just controlling accuracy of all of the numbers and the cash flowing through the business. And that's a lot. There's a lot to that, and it's very important for day-to-day operation. But a true CFO, to me, is on par or should be on par, knowledge-wise, experience-wise, and have a strategic mind alongside the president or the owner of the company. They can and should be working hand in hand with the strategy. So that would be a forward-looking person that's dealing with strategy, to be sure that they're looking at a strategy going forward and executing on the existing strategy on a day-to-day basis. And another piece of that job that's really important is managing the financing and the cash flow. Oftentimes, legacy businesses will have plenty of cash, and if they're fortunate, they don't have any loans outstanding. They'll pay everything in cash. I've also got an example of a very long-time friend that runs a business, and they pay off everything out of cash, and they're a capital equipment heavy company. And I've talked to them many times about utilizing their cash for something other than paying off $1 million piece of equipment as quickly as possible, because they're paying off a depreciating asset as opposed to using that cash for investments or to, well, actually you could have it investing in a market where, up until very recently, interest rates were so low that you could acquire a piece of equipment for 3 or 4, maybe 5% interest over 10 years or 5 years. Whereas that cash could be, if it's invested well at all, could be earning at least 7, 8, 9%. But they just are insistent on paying everything off. And they say, well, that's the safest way to go. Well, what I maintain is, if you let's say that you operate like that, to where you have no debts and all of your $5 million worth of equipment is paid off. If you had that equipment financed at a reasonable rate for the period of time that makes sense for it, let's say it's 5 years, or even 10 years. Some of the equipment, $1 million piece, it might be, it might last for 30 years. So there's nothing wrong with financing it for 10 years at a reasonable rate. What I maintain is, let's say 3 or 4 years into the life of that equipment, all of a sudden your industry is hit on it with a downturn. So now your sales drop from $20 million a year to 15 or 12. Now, all of a sudden, you've got a serious hit on your business. You're laying off employees. You're maybe having difficulty collecting on your accounts receivable. And so you're in need of cash more than you ever have been. If you're financing that equipment and the industry or the economy in general is really in a tough place, the banks will negotiate with you. If you need to stretch your payments out, miss a few payments, you have negotiating power with a financial partner. If you have just the equipment paid for, there's no help there. Nobody's going to buy your equipment. Of course, you still need it. Nobody's going to refinance your equipment and give you cash to operate on. You've locked yourself into a situation where you are asset heavy, and that's it. Whatever cash you have or lines of credit you have, then you're going to have to deal with that. If you finance the equipment, your money, your cash is already working for you in a different realm, so you have access to that cash. But if things get really tough, and you run out of that cash even, then you negotiate with the banks. But it just gives you it gives you another tool, in your toolbox in the event that things kind of go pear-shaped on you, based on a lot of different things. I've seen legislation at the national level change this particular business I'm thinking about to where their products can't be sold overseas, or they can't use their product for their purposes because industries have been sidelined due to environmental issues or, a number of things. So I maintain that debt is good for the right reasons. Now, if you've got credit card debt run up because you're driving expensive cars or living too large on a personal level, that's a whole different thing. But if your business is equipment heavy and capital equipment heavy with no debt, then you could put yourself in a situation that could be a little bit onerous somewhere along the line. So I would encourage whoever you've got in your company as a financial partner, or if you don't have that, to look elsewhere for it. You may look I'll throw in a little ad for what I do, the strategic planning and the peer advisory groups that I operate. Those are the types of things that we talk about with the groups of CEOs and executives that I deal with. And they can ask each other, hey, how do you finance your equipment? How do you finance your business? What does your controller do? Oh, you don't have a controller? Well, what does your CFO do that your controller didn't do? And those are great conversations to have, to learn from your peers in the peer advisory group setting. But it's a great way to just continue to make sure that your business not only exists, but it thrives and grows over time. And as you evolve in your industry, make sure that you're one of the top performers, and so that when times are tough, you're still one of the top performers. So anyway, I really enjoy talking about the financial side of the business. It's a very important piece of it, and one of the areas I see often that doesn't get the attention that it really should get, to make sure that your business is healthy in rough times as well as in good times. So if you ever have any questions about that, you know where to find me at Larry@mercuryleadership.net. and we can always talk more about the financial side of the business. And so that's it for today's episode on controller versus CFO. I'll be seeing you in the very near future. If you have any other questions, check us out at mercuryleadership.net. See you soon. Thanks for listening.